Live from Singapore, this is Insight with me, Haslinda Amin, a show where we dive deeper into the stories that matter with crucial context and sharp analysis. President Trump makes a big reversal on U.S. policy towards Ukraine, agreeing in a phone call with Vladimir Putin to negotiate an end to the war. Asian equities rise on optimism over the U.S.-Russia talks and improving prospects for Chinese stocks, ignoring hotter than expected U.S. inflation figures. Alibaba extending a rally that so far clocked around $90 billion. Prime Minister Narendra Modi is in Washington, hoping his friendship with Trump will help India dodge any tariffs. Ahead of the meeting, Indian equities fell to the lowest since early June. And Tim Ford, CEO of Treasury Wine, will be joining us for an exclusive interview after the company's weak earnings guidance sends its stock lower. We'll also ask him about the risks to Aussie wine exports from Trump's tariff threats. Our top story today. President Trump says he's agreed in a phone call with Russian leader Vladimir Putin to start negotiating an end to the war in Ukraine. It reverses 3 years of U.S. policy on the conflict, with European officials getting no advance warning of the agreement. Trump says meetings with the Russian president are now being planned.
I'll be dealing with President Putin largely on the phone, and we ultimately expect to meet. In fact, we expect that he'll come here and I'll go there, and we're going to meet also probably in Saudi Arabia. The first time we'll meet in Saudi Arabia, see if we can get something done. But we want to end that war. That war is a disaster.
Let's get insights from George Friedman, founder and chairman of Geopolitical Futures. He's an internationally recognized forecaster and strategist on international affairs. George, good to have you with us. On the surface, it does look like the U.S. is ditching Ukraine. Is that a fair assessment? Is that the way to look at the latest developments?
It's to look at the fact that the Russians lost the war. The major Russian army failed to achieve its capabilities, taking only 20% of the territory. The Russians had to end this war. The U.S., Trump, before the election, said, look, this is primarily a European war, not an American war. He felt, and there's reason to think, that the Europeans didn't do nearly enough to do it. So the only thing they could do was that a war the Russians couldn't win and would crush Ukraine, would go on indefinitely. So rather than regarding this as the U.S. abandoning Ukraine, it's the U.S. helping to end this war.
The thing is, with Trump's suggestion of talks between Russia and Ukraine, it does seem like Ukraine is on the losing end of the negotiation. It was not even part of negotiations or part of the talks that he had.
Well, Ukraine exists because of the massive American help. Ukraine could not defend itself. If the U.S. wasn't involved in it, it would have ended differently. The fact is that U.S. Tools and Ukrainian soldiers and lives stopped the Russians in their tracks. And so now we are looking at how to end the war. The idea that the war can continue, well, the Russians can't continue it, and the Ukrainians really can't take it anymore. And the Europeans don't want to get in. So this is a war that's lost its meaning. A quick Russian victory would have been something that changes the world. This is just bogged down.
Can Ukraine at this stage have a say in its future? How are you assessing Ukraine's ability to negotiate its future?
Well, its future was nil until the United States got in. Its future, if the United States pulls out, is nil if the Europeans don't come in to take its place. So they have a very weak hand. But on the other hand, they achieved something extraordinary. They stopped the Russians. And from that point of view, the Russians have to both be impressed and recalculate what they think about Ukraine.
How will this play out, George? We've heard from the U.S. saying that, you know what, it will be unrealistic for Ukraine to think it can recover the land that's already been occupied by Russia. We've also from the U.S. saying that, you know what, you can forget about being a member of NATO. How do you see this playing out? And what does it mean for Ukraine and Russia at this stage?
Well, if the Americans said this to keep fighting, that we would be saying, fight to the last Ukrainian life. The loss to the Ukrainians in life and wealth has been enormous. So the Ukrainians, I suspect the public by and large, wants to end the war. They hadn't lost much, less than 20% of their territory. They still have their autonomy. And it's quite likely that if the Russians really decided to throw everything in, well, they might defeat the Ukrainians. So resistance may prove disastrous to the Ukrainians, and I suspect that on the whole, inside politically, they will be appalled and privately quite relieved.
Right until now, George, we know that the U.S. has defended Ukraine and Ukraine's position, providing everything that it needed, including military support. And just wondering at this stage, for its allies, U.S. allies around the world, should they be questioning the reliability of the U.S. as an ally?
Well, the U.S. is questioning the reliability of their allies. Do their allies have the ability to stand for a long time, as the Ukrainians did, and hold out and take the pressure? Or do they simply expect the United States to be their alternative? And this has to be something the U.S. renegotiates. The expectation that the United States is committed to defend every country without the country defending itself is not realistic. Ukraine defended itself. The United States came to its help. It did not have the stomach, nor did the Ukrainians, driving the Russians back. So either it ends here, or a lot of Ukrainian lives and very few American or European lives will be lost.
We talked about how now it is left for Europe as well as Ukraine to defend Ukraine. I'm just wondering, how should Europe be assessing this? It is not in a position to actually defend Ukraine. It's not a position it wants to be in.
It doesn't want to be in it. It could defend Ukraine. There's a substantial German army, a substantial British army, and a French army. All of them could have come and fought. They have a substantial defense industry. The Europeans chose to allow the Americans to make the main stand. They did support in various ways, sometimes grudgingly, sometimes generously. But it's not true that the Europeans don't have options. They don't want to have the option. They could easily step in if they wanted to. But rationally speaking, this war is not winnable in the sense of driving the Russians out, and the war is not winnable in the sense of Russia taking Ukraine. It's a draw.
So if Europe can actually defend Ukraine, will it? Do you see Europe playing a bigger role? Do you see eventually Europe being forced to play that role?
There is no eventually. If it goes into Ukraine after the treaty, then it has to go into offensive operation. The Europeans have demonstrated they have no stomach for intense operations in the past few years. I don't think they're going to start it because they don't seem to feel that they are that threatened by it. Rhetoric aside, the Americans came in, did not get the kind of support they expected from their European allies, and now they will choose to continue their modest involvement.
George, there's been a lot of debate and discussions about Ukraine tapping the frozen Russian assets to help it rebuild. Do you see perhaps the U.S. agreeing to this because it would be in its benefit?
Well, certainly. I mean, this will be what the negotiations are about. Wars end with negotiations. Each side has to give something. The Russians are giving a great deal they already have. The Americans will give very little of their own. But the Ukrainian side will certainly have options of refusing to take this peace unless they get the Russian money. I doubt that they will do it because I don't think that money is enough for them to continue the war and keep costing lives.
From a macro perspective, George, how do you see this development shaping the future world order? We know how Trump is already reshaping, the global trade order. What will it mean politically, strategically? What does it mean for the world order?
The reality is there. Russia is no longer a major military power and is struggling with its economy. It's out of the game for a while. This failure shows that. Whether Putin can survive the failure, I don't know. The only major global power now is the United States. China is militarily much weaker than it looks, and I think that its economy is staggering, frankly. So at this point, the U.S. has options that other countries don't. Russia doesn't have an option of continuing the war. The U.S. doesn't desire to continue the war in Ukraine, and there's no third party to get involved.
Does it necessarily mean that perhaps other countries will be looking at their regional arrangements, like perhaps the Five Eye arrangement would be more in focus for the likes of Australia, for instance? Would those kind of defense strategic arrangements be more important to countries now?
They were always more important to the countries. The question is, the United States has, throughout the Cold War, maintained a stop Russia at any price policy, stop the communists, whether they're Chinese or this. The Cold War was over in 1991. That policy continued, and this was the end of the Cold War, really. This is the time when the Russians are no longer a global threat. The Americans have other fish to fry, and relations with new countries, particularly India and I think Turkey, will be looked at seriously by the Americans.
George, thank you for joining us. Great insights. George Friedman, founder and chairman of Geopolitical Futures. Still ahead this hour, the CEO of Australia's Treasury wine estate will be joining us after the company cut its annual earnings guidance. Our exclusive with Tim Ford is next. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Here's a look at the Aussie dollar. Its rally has petered out in recent days after a Trump advisor said Australia is killing the U.S. aluminum market. Those comments came as the government seeks an escape from President Trump's tariffs. He spoke with Prime Minister Anthony Albanese earlier this week, saying he would consider a possible exemption. Let's discuss how heightened trade risks are impacting Australian companies such as Treasury Wine Estates. Its shares fell the most since 2023 today in Sydney after narrowing its full-year guidance to the lower end on weakness in its premium brands. Joining us exclusively is the CEO of Treasury Wine Estates, Tim Ford. Tim, good to have you with us. First off, we know the world pretty much preoccupied with those Trump tariffs. I mean, how are you assessing the possible impact on Australia and Australian companies?
Yeah, good. Thanks for having me. Look, from our perspective, having such a large business that is in the United States, that is US wine, luxury wines that we make in America and sell in America, I guess for our company itself, we actually see some of the protectionist policy and tariffs that are likely to be put in place, if you believe that's what's going to happen, as a net positive for us as an organisation. Fortunately, we have a very big centre of gravity there in the United States.
Do you see Australia getting in the crosshairs of relations with the US? I mean, after all, we've seen how relations have been pretty topsy-turvy of late.
Yeah, look, we've got a lot of history with engagement with governments around tariff implications in our business, with the China tariffs on Australian wine, some 4 years ago, which luckily now no longer exist for our wines in that market. So we watch that very closely, and we engage with our government very closely. I think the government play a very key role in this, and their track record over the last few years would suggest that they understand, the role they need to play and to manage that through to make sure that, trade relations are as positive across multiple countries. But it's a balancing act they need to find.
The thing is, tariffs might cause shipments from elsewhere to drop, demand to drop. Might Australian, winemakers, wine companies actually benefit from that?
Could do. Yeah, definitely could do. And that's why we see it as a net positive, for example, for our US business because of that reason. And I think, if you look at the Asian markets being such a very large, part of the Australian wine broader category overseas, I think certainly a trade war between China and Asian markets and the US could benefit Australian wine. There's no doubt about that.
Is there a way to quantify how much you might benefit from it?
Very, very hard because you speculated on what might come in the future. So from that perspective, I think directionally, we feel pretty comfortable it would be a benefit, but very hard to say until something was actually set in stone.
Of course, we're having this conversation against the backdrop of a glut in the wine market. How do you see this playing out?
Yeah, the glut, there's two tiers to the wine market, the way to describe it. You have luxury wine, which is they're called $30 and above, and then you have sort of the lower price wines, and obviously there's price points all the way through. But the glut in the market here in Australia is at the lower price points. It's a category that's challenged. Fortunately for us, it's a very small part of our business. And we've certainly recentered our growth around our luxury brands, both here in Australia, but in Asia and in America as well. So over time, that will normalise, but it's also not part of the market where we really play in any significant way anymore. It's happened over time, and it will get smoothed out over time.
Oh, well, the thing is, if your focus is the luxury market, where are you seeing the most growth? And perhaps is this a reflection of, the wealth that's growing around the world?
Yeah, look, consumers are everywhere around the world are drinking less but drinking higher priced wines. That's a trend that's been going now for a number of years, pre-COVID, through COVID, after COVID, and it's going to stick. And we're seeing that everywhere. So we expect that to continue. We've shifted our business and our centre of gravity of our business to those luxury wine portfolios, and that'll be our future growth. That's where our investment's been, that's where our acquisitions have been, and that's our brand investment as well. So we certainly see that continuing across the whole category, nearly in every market around the world.
Does that also include China, where you've reintroduced the Penfolds brand in that market?
Yeah, absolutely. China, pleasingly, after 6 months essentially back in the market, Penfolds is back as the number one luxury wine brand in that market now. So we're very happy with the way we've executed the re-establishment of our business up there in China. But it's also through some of the other Asian markets. Southeast Asia, is a fantastic opportunity, not only for our business and our brands, but the Australian wine category as well. And consumers love brands. Those that invest behind brands, build brands, and have that emotional connection to brands, consumers are willing to pay. And we certainly see that across nearly all of the Asian countries. So it's a big, big opportunity, no doubt.
Tim, is it surprising that you're seeing that strength in the Chinese market, given that consumption remains lackluster? The government has been unable to revive consumption. I mean, how strong do you think, your performance is in the Chinese market? How sustainable is that?
I think it's very sustainable just purely on the fact of the strength of the Penfolds brand. So we've been very focused on bringing that brand back to the market in China, not a number of our other brands, because we feel like the strength of that brand's really what's driving it. So from our point of view, we're starting to build the distribution now. The growth we've seen in the last 6 months was as we'd expected it to occur, and we see there's multiple halves ahead. I mean, the guidance we've given the market for our Penfolds business, is for multiple years ahead. F26, F27 of 15% growth. And we're very confident of that now after being back in the market in China in particular, and given the strength of the other markets around the world. So, very confident.
Speaking of growth and speaking of the demand that you're looking at, are your goods being boosted by the stronger dollar? It makes your exports cheaper, so to speak.
Yeah, look, it certainly helps us in terms of the translation of our earnings in the US back to Australia, for example. Not overly significantly, but certainly is a tailwind, a slight tailwind. But we don't make the decisions short term around currency driving the strategy of where we're going to build brands around the business and in what markets around the world. certainly having a diversified business in multiple markets across Asia, Europe, America, and here in Australia and New Zealand, then gives us a natural hedge. So in some markets it's a benefit at a point in time, in other markets it's not. We've found over time that that's the best strategy, to have consistency of earnings and consistency of growth year on year. Otherwise, you get the whiplash effect of trying to react too short term. And in a wine business where you're building brands, consumers don't really care about foreign exchange, but it helps in some of the investment levels, in some markets around the world, no doubt.
As you said earlier, Tim, that your focus is on your luxe brands, not so much on the smaller brands. You've tried to divest those smaller brands, but you didn't get the price that you wanted. What now? What happens? What's the strategy from here?
Yeah, no, we did work to sell or put on the market to seek to sell 4 of our commercial brands, the last of our commercial brands that we have in this business over the last 6 months. That was unsuccessful. We couldn't achieve a price that was appropriate from a valuation perspective. So we'll continue to trade those brands. We'll continue to sell those brands. To put them into context, they form part of our Treasury Premium Brands division. And within that division, it was 6% of our earnings that we talked about today for the first half, and it's only a component of that 6% of our earnings. So for us, it's about driving that volume of these brands through the retail networks that exist today. They won't be a growth engine for us going forward, but they'll just play a role in terms of that volume. So our focus continues strategically on our luxury brands regardless.
In the broader macro environment in Australia, we know that Australia is on the cusp of the federal election coming in months. I'm just wondering, what meaningful policy change would you like to see that would be helpful for your business?
Yeah, I'd like to see the trade relations and the ability that this government's shown, over the last 3-4 years to stabilise trade relations continue, with whichever government wins the election, come later on this year. So for us, for our company and our business, that is without doubt, the most important role and expectation we can have of government in unlocking future trade opportunities, whether that's through different markets around the world or trade agreements, etc. That's where we spend most of our time, working with government and encouraging them and influencing them where we can, to ensure that we have that ability.
Tim, before we let you go, a very important question, and that is, are you planning to launch more wines with Snoop Dogg?
Yeah, well, the Snoop Dogg portfolio has now been rebranded as Cali by Snoop, and it's still going well in the United States. It came out of nowhere 4 years ago now and was overnight 1 million cases, and it slowed down a little bit, but his popularity in the US, particularly since the Olympics, has spiked. So we've got some great plans with him going forward. We'll continue that relationship. So, that's going to be ongoing.
We're looking forward to that, Tim. Thank you so much for your time today. Tim Ford, MD and CEO of Treasury Wine Estates. Now, let's take a quick look at Aussie assets. We know that the stock market is in positive territory, currently up by about 0.2%. We're actually keeping an eye on bond yields, of course, on the back of that yield surge in the US. Bond yields pretty much trending higher as we speak, pretty much across the board in Asia as well. Now, still to come with US CPI figures coming in hotter than expected. Traders are now expecting only 1 rate cut this year. Maybank Group's Eddy will be joining us next with his market insights. Keep it here with us. This is Bloomberg.
The 6-month annualized core CPI had fallen to 3.1% on a 3-month and 6-month annualized basis. So I think in the months that come, in the very near term, that inflation is going to become much less of a concern for the Federal Reserve.
But I do think it's also smart to have come down in terms of the consensus view on an even larger number of rate cuts. I think it's a pause here, and we'll have to see what Trump decides to do in terms of enactment of new policies, and that will have an impact on inflation in general.
If there are more tariffs for the US, what would that mean for inflation? Because, of course, tariffs would be inflationary for the US economy, and that's not something that he really wants. But it seems to be such a central pillar of US government policy right now.
Some of our guests reacting to the hot U.S. CPI print. Well, the U.S. data has triggered a fresh repricing in Fed rate cuts. Avril Hong is here for a closer look at the numbers and the market reaction. And so far, Asia seems to be okay.
Yeah, we're actually seeing gains pretty much across the board in the region. But let's rake through the data in the US first, because when you look at the hotter than expected numbers, it's coming through across the board. And on the core print, it jumped by the most since March. In terms of the repricing that's underway, the full rate cut from the Fed's been pushed back from September to December. Clearly, inflation is a concern, and this is even without tariffs. And Powell has acknowledged there's more work to be done. Have a listen.
We're close, but not there on inflation. And you did see today's inflation print, which says the same thing. I mean, we've made great progress toward 2%. Last year, inflation was 2.6%. So great progress, but we're not quite there yet. So we want to keep policy restrictive for now.
Now, in terms of the market reaction, we saw a steep sell-off in U.S. Treasuries, and this is a bit of a recovery. If you flip the board, you should see that there's a bit of a rebound in terms of U.S. bonds underway today. Keep in mind that Powell did say they have more work to do, but kind of in the same breath also said they don't get too excited about one or two prints, whether good or bad. And then you look at Bloomberg Intelligence, they recently also put out a note that says, disregard the hot numbers because there was potentially this January effect at play. Start of the year is when firms hike prices or fees, and that might not be properly accounted for in the data. So we're seeing that recovery in treasuries. Asia stocks, as we talked about, also higher today, led by Chinese tech. The dollar holding steady, maybe watching out for more tariff information or news. Flip the board. Among the currencies that are sensitive or at risk to tariff news and the higher U.S. yields, the Japanese yen. And today, the levels you're seeing of 154 on dollar yen pretty much erases the rally on the past week that we've seen in the Japanese currency. And if you take a look at this chart, courtesy of MLI's Mark Cranfield, it will show you how closely related dollar yen is to the higher U.S. yields, the 5-year in particular.
And Avril, when there's so much noise, it is difficult to disregard data for a Fed that is data dependent. Avril Hong, thank you. Let's get more on markets with our next guest, who believes the Fed will continue to cut rates, but less aggressively. Eddy Low is CIO of Maybank Group Wealth Management. Eddy, how can you be less aggressive when you're only pricing in one this year? Are we saying none, or are we saying perhaps even people should be talking about a rate hike instead?
Well, we started actually in the year, last year, we were talking about 3 rate cuts in 2025. But subsequently, obviously, we looked at the data, we acknowledged the upside inflation risk, especially with Trump's threats on more tariffs for the entire world, right? So we see upside risk, not to just inflation, but also growth. And therefore, we have actually pared down our rate cuts forecast. Actually, it's from 3 to 2. But obviously, we cannot rule out maybe even 1, which is what the market is pricing in at this juncture.
We heard from Avril saying that perhaps, people are saying, forget about the hot number, there's the January effect. But the thing is, if CPI continues to trend higher, if the data continues to be strong, then you have to reassess again, reprice again.
Of course, I mean, inflation data is something not just the Fed is watching, we are, as investors, are watching very closely as well. But if you think about it, last year, first Q 2024, it's a bit of a deja vu. We had a bit of an inflation scare as well, which led to a spike in rates at the same time, right? So, but then subsequently inflation falls. So if you look at this month's, the latest January January CPI. Avril talked about that January effect. And there was also this component about egg prices. Egg prices actually went up 50% year on year because of the bird flu, right? So that is more of a one-time shock. And if you look at the nowcast, the Cleveland Fed nowcast for the February month, it's actually pointing slightly lower. This month we had it at 3%. It's now pointing at 2.8%. So I think it's premature to say that, this whole inflation story or trajectory is being derailed.
What you're saying gels together with what we're saying in the stock market, but not really being bought by the bond market. We're seeing how yields are trending so much higher. We saw that massive sell-off just overnight in the U.S. How are you reading that? Are we talking about, perceptions of those bond vigilantes rearing their ugly head again?
Well, we think that this inflation expectations, shifting inflation expectations is going to continue to lead to more volatile Fed rate expectations, and that's going to lead to 10-year Treasury yields also bouncing around. So we are looking at a range of between 4 to 5% for the course of this year. At 4.6%, we thought that the risk reward is actually pretty decent, because if you were to buy 10-year Treasuries at 4.6% today, even if it moves up to 5%, that high starting yield, actually that's going to help to mitigate some of this rates downside risk. So you actually not lose money, even if rates 10-year Treasury yields were to move to 5%.
4 to 5% is actually what has been expected for a while now. What would it take for 10-year Treasury yields to get beyond 5%?
Well, I think inflation is definitely one of the key things, meaning to say that if inflation, U.S. inflation were to shoot up, right now we are at 3%, say, for example, unexpectedly, if we were to move up to, say, 4 or even 5%, that's going to put a lot of pressure on our Treasury yields at the same time. And therefore, that could be one possible scenario. The other scenario, which you just mentioned the word bond vigilante, right? I think that's something that the new Treasury Secretary is quite concerned about as well. And therefore, because if the U.S. government were to issue more Treasuries, then perhaps investors will be concerned about is that the situation, and then therefore demand higher yield to compensate for the additional risk.
Can the resilience in the equity market persist from here? Can we see the same kind of increases that we've seen the last 2 years, S&P surging more than 20% both years?
We think so. And
really?
And this primarily on the premise that we think that growth is going to remain robust, right? And both in terms of macro as well as corporate earnings, right? For example, U.S. People talk about U.S. exceptionalism. We think that U.S. leadership is likely to persist. But having said that, over the past 2 years is all about a lot about megatechs. But right now, actually, if you look at the latest 4Q earnings, we are actually seeing a more even distribution of growth contribution, not just from the megatech, but also from other sectors like the financials. They did very well in this quarter.
So the rally will be broadening?
We think so.
Where are the biggest opportunities? If you don't play the megatech, because you've seen such a massive rally, where would you be putting your money?
Well, I think the banks, the financials is one area of interest for us.
But even then, the banks have risen in the last several quarters, including those in Singapore.
They did, but we think that they are still in a good place because they are going to benefit. One, I think you're talking about deregulation, right? That's going to help to release excess capital, improve shareholder returns, and then deregulation also can help to, I would say, revigorate. Markets have been talking about improving M&A activities, right? And that's going to benefit the banks, especially those in investment banking.
Surprisingly or not, China has been an outperformer, had a very strong start to the year, 14% or so since Jan. Are you buying into that rally? Has anything changed fundamentally?
Selectively, I think we always see opportunities in China. We don't think we are not in the camp of China is not being investable, right? And obviously, this year's rally is really a lot of triggered by DeepSeek's development. So we saw a lot of the related tech companies rallying over the past 3 weeks. Having said that, I think some of these stocks are actually exhibiting a little bit of over-exuberance.
And that includes the likes of Alibaba?
Well, not going to specific stocks, but yes, I think we are looking at some of these. So we will rather actually broaden out to other opportunities where value actually may persist. And then one of the areas is actually in the property sector, which may be a contrarian call because we know that it's going to take a long time for the property sector, China's property sector, to bottom out. To repair. But I think at the same time, the valuation of some of these companies within the sector are actually very attractive, pricing a lot of negatives. And I think their ongoing concern is really not a concern. So we think that there are selected opportunities within the property sector as well.
But the thing is, the valuations in the property sector have been there for a while now. They weren't attractive before because of the fundamentals. They weren't attractive before because the stimulus was not enough to turn around the property sector. What's changed?
Well, I think if you look at the recent announcements, especially with the government's plans to actually support, apart from all these property easing measures, I think the latest news about the government thinking about a funding plan to support a banker, which is a state-linked company or developer, I think suggests that there are actually companies that may be deemed a little bit too big to fail. And I think that actually is another gesture to show that the government is actually prepared to step in where necessary to really backstop the property sector.
How soon do you think we'll see a recovery in China's property sector?
I think the question is actually not about, we're not anticipating a V shape, but I think if there is some form of stabilization of the property sector, that will be helpful, not just for the property sector, but actually for the entire economy, because of this wealth effect. It's going to improve consumer sentiment, and that's, I think, going to benefit the entire Chinese stock market.
So time to look at the Chinese property plays.
Selectively.
Selectively. Let's talk about FX. Interesting big moves in FX. The dollar remains the key factor. The mighty dollar remains a key factor. How are you assessing the yen and where it goes from here? It's had quite a volatile ride.
I think it's going to continue to be like that. And then I think there are two fronts here. Dollar, given the fact that we still have quite a fair bit of external uncertainties, especially with Trump, that is actually going to be supportive of the dollar or the greenback against the rest of the world, at least in the first half. But on the flip side, I think what is interesting is the yen, in the sense that I think the BOJ, the Bank of Japan, has reasons to further normalize its monetary policy because inflation is indeed ticking up, and then I think it's hitting their inflation target, right? They have been facing this deflationary issue for so long. Finally, inflation is hitting its target, so they are watching. I think we are expecting them to hike 2 more times for the rest of this year. So bringing the current policy rate from 0.5% to 1%, which is actually still low compared to the rest of the world. But I think this further normalization of monetary policy, that's going to be supportive of the Japanese yen as well. So now we are looking at dollar yen at what, 154, 155? We think it could actually head towards 150 and then potentially even lower towards 140 if we do get both the normalization of BOJ as well as the Fed rate cuts.
The yuan and the rupee also in focus. It does seem like the PBOC, RBI have been supporting the currencies. Yes. The question is how much longer, and where will they end 2025?
Well, again, you look at the actions from both central banks, PBOC, I think RBI. They have actually just recently came out to, well, you can say intervention to really prevent a collapse of the rupee, right? So I think at the end of the day, the central banks wants to ensure some form of stability in the currency, because I think if not, that's going to affect sentiment of the entire economy as well. But a lot of where the currency is going to end up, right? I think a lot depends on the greenback, right? Because on a trade-weighted, I think the Chinese or the Indian central banks, they are looking at the currency from a trade-weighted basis. So if the US dollar were to strengthen against the rest of the world, they can let it go a little bit, right, in tandem with the rest, but not too much. If too much, they will come in to intervene.
That's right. So within the basket, they're quite comfortable. Eddy, thank you. Eddy Lowe, Maybank Group Wealth Management there now. Turning now to oil, which is under pressure after President Donald Trump and Russian leader Vladimir Putin agreed to talks on ending the war in Ukraine. Meanwhile, the CEO of Brazilian state-run oil giant Petrobras says the company can handle lower global oil prices as Trump calls on U.S. producers to drill more. Speaking exclusively at the India Energy Week in New Delhi, Magda Chambriard told us about Petrobras' strategic plan and gave her target for prices.
We are growing our oil production. We are growing our refining products. We are growing our petrochemicals. And at the end of the day, we are not afraid to compete on the international markets. Petrobras has its markets. It's there. And we are not facing problems to put our products and our commodities in the market.
But you see more growth than you had even anticipated last year when you set out the 5-year plan?
No. Everything is solved for us. We produce around 3 million barrels a day. We have a huge internal market, and what we put on the market has a certain place to be, and everything is okay for us.
Do you have a view on where you expect prices to go? Because this is also the year people are expecting that OPEC will restore production, but that is a many trillion-dollar question, really.
No, what we expect by now, after Mr. Trump election, is a little a level of oil price a little smaller than we have been having. So we had in the early month of January something like $80 per barrel. We are now a little less than this.
At about 76, 75, yes.
Maybe between 70 to 75 is our bet. But more than this, wonderful, and Petrobras is very resilient. So everything much less than this, we can survive, and we can put our projects on the markets without any problem. Our calculations say to us that we have been very resilient to oil prices.
So if you expect additional supply from either OPEC or even from the US, and if prices were to go as low as 65, do you expect there to be a significant chance for that kind of fall in prices? And will that make your expansion plans in any form unviable for the short term?
No, our 5-year strategic plan is completely resilient to 65, and I don't believe prices can go much down than this, even because United States has to sustain the unconventional production, so I don't believe in much less than this.
And that was Petrobras CEO speaking to us exclusively at the India Energy Week in New Delhi. Still to come. India's Prime Minister is in Washington amid looming tariff threats and relations, which are not quite as they were 5 years ago. More on the Trump-Modi meeting agenda next. Keep it here with us. This is Bloomberg. Welcome back. Indian Prime Minister Narendra Modi has arrived in Washington for his meeting with President Trump. The Indian leader is likely to face a minefield in negotiations with Trump, who has signaled that India remains a potential tariff target. And Modi's visit comes as Gautam Adani, who is alleged to have close ties with the Indian leader, has also been busy building up political influence in the U.S. For more analysis, let's bring in our government reporter, Sudhi Ranjan Sen in New Delhi, and conglomerate reporter Pierre Sanjay. He joins us from Mumbai. Sudhi, let's start with you. What's at stake for Modi in these talks? We know that Modi is going to negotiations having made early concessions.
Well, I mean, a lot is at stake for Prime Minister Modi and, in fact, for India, because if you look at it, India looks, or Prime Minister Modi, let's say, is looking out to the US and its Western allies and its partners like Germany, like France, for technology, in particular with the US. India is looking out for tech. That's the big thing that Prime Minister is looking out for. And cutting-edge tech, like jet engine manufacturing, like semiconductors. At another level, United States is India's biggest trading partner. India also has a trade surplus of about 35 billion. So if you look at the trading and the trade and commerce relationship, the relationship with the US is one of the relationships that's very, very important, and there is no way that India can allow that relationship to deteriorate or meet with a hurdle.
Sudhi, what you're suggesting is Modi will have a difficult time negotiating. Why not? The two leaders have really good relations. Is it a case of it is different this time?
It is very, very different this time, because if you look at when the last time the two leaders met, the circumstances were different. Today, President Trump on his second tenure is looking to fulfill his promises to his core constituency, and those include bringing back jobs to the United States, cracking down on illegal migration. India has made a very, very early move, signaling to the United States that no matter how many undocumented Indians are there in the United States, India is going to bring them back. The government was under pressure when many of them landed up in handcuffs in India, but nonetheless, I mean, that was a clear signal that Modi sent out to the United States, saying that we are willing to work with you, and the reason is again the trade and commerce relationship. So a huge, big stake for Prime Minister Modi, but we must also remind our viewers, President Trump has clearly singled out India, saying that it's one of the biggest abusers of tariff, and India being slapped with tariffs is not going to be good news for Indian business or for Prime Minister Modi politically.
And Sanjay, speaking of the U.S., your reporting suggested that Gautam Adani is looking to build influence in the U.S. What more can you tell us?
Haslinda, this is a developing story, and today there is Indian Prime Minister Narendra Modi set to meet Donald Trump, and there will be a press conference also. So it's first of all, it's a developing story, and like any other conglomerate which is indicted by DOJ on alleged bribery scam, they would definitely try and leverage their ammunition more. They will create more, war chest. So they are appointing legal firms. They are also appointing legal experts, consultancies. They are also approaching lobbies to get their side heard in front of DOJ and as well as with White House as well. So, what we are picking up is that they have not appeared before court, and they have not submitted any replies, detailed replies to DOJ. And what we are picking from Adani camp is that they have not been told, there was no deadline or there's no time frame. Instead, they are now going ahead and meeting all these legal experts and to get their side heard. And the good thing is that Trump is now doing away with, or rather pausing the FCPA, which is a great news for Adani camp.
And Sudhi, Modi set to be meeting with Elon Musk while he's there. What do you think they'll be discussing?
Well, we are trying, that is something that is on the cards. That is something that diplomats are also indicating. And from briefings earlier, before the visit from U.S. industry bodies that we have heard, is that the discussion, if the meeting happens, the discussions are definitely going to be around Starlink and Tesla in India.
All right, Sudhi, thank you. Sudhi Ranjan Sen in New Delhi, PR Sanjay in Mumbai. And stay tuned for our next episode of Latitude. I head to India to speak with Nita Ambani, the matriarch of Asia's richest family and a key player in Reliance. Keep it here with us. This